Imagine this, you've managed to pay off your mortgage 15 to 20 years ahead of the original plan, and now you have a choice. Either you already have some passive income coming in that is enough for you to retire early and quit your 9 to 5 job, or you're a bit late to the passive income game and now you're going to spend a few years gathering some savings which you can invest for passive income. But either way, that is it. You're done with your 9 to 5 job before the standard usual age of 65. So go and retire early and enjoy the rest of your life. Now, I know you're probably thinking all of this sounds very far-fetched, like you work 8 hours a day to earn an income so that you can pay your bills and your mortgage until you're 65, and this guy on YouTube is saying that I can pay off my mortgage 15 to 20 years ahead of plan and then retire early. Yes, this is exactly what I'm saying. Now, for the majority of you, retiring early by paying off your mortgage much sooner and essentially never working a 9 to 5 again is probably more of a dream than reality right now. But I'm here to tell you that, you know what, it can be done. On this channel, I already made a video on exactly step by step how you can replace your salary income with passive income from investments. And passive income is income you make while you eat, while you sleep, while you're on holiday, and I showed you exactly how to do this. But one of the barriers for many people to build up their investments in the first place is their mortgage. Their mortgage takes a lot of their money every single month. Now, the average mortgage monthly in the UK is £669. Now imagine you can take this £669 every single month and now it can go towards your investments because you have paid off your mortgage early. Put it this way, £669 invested every single month for 20 years at a 10% growth is £500,000 by the end of 20 years. Yes, £500,000. That is the power of compound interest. So a mortgage is one of the biggest factors that holds up a lot of people from ever building up any savings or investments. People always want the biggest home possible, so if you have a higher salary, you end up having a much higher mortgage monthly as well. So, by the end of this video, provided you watch this video till the end that is, you'll know exactly what you need to do so that you can save a ton of money off your mortgage and pay off your mortgage much sooner. One of the key things to allow you to quit your 9 to 5 job and retire early. So do stick around till the end. Hey, what's up people? Welcome back to our channel, Rao Finance UK. So let us get straight into it. Now, the UK economy is in a recession. Now, usually when this happens, the Bank of England, the central bank for the UK, they lower the interest rates as a way to make money cheaper to borrow. And so people end up spending more, which gets the economy rolling again. And mortgage rates have now fallen below 3%, which means remortgaging your home now could save you a ton of money. Even Warren Buffett, one of the greatest investors in the world, even he agrees that now is a great time to remortgage because the interest rates are so low. Now, if you do this correctly, what you'll find is that you're able to pay off your mortgage much sooner. I'm talking about many years coming off your mortgage term. And in the process, you also save hundreds of pounds every single month. Now, you're asking, how is this all possible? Well, with the interest rates at record lows, nearly 0%, that means that it is almost free to borrow money, which isn't the best of news for the banks because it cuts into their profits, but it is very good news for you because money being cheaper to borrow means you can save hundreds of pounds per month on your mortgage payments than you would if you took out the exact same loan, say a year ago. All you have to do is remortgage to a mortgage with a lower interest rate. So how does remortgaging work? Well, when you remortgage, all this means is you move lenders and you're essentially taking out a new loan. Your new mortgage lender will then pay off your existing mortgage, but your new mortgage will have a lower interest rate compared to your old one due to the current interest rates being so low. This means you will have a lower monthly mortgage payment and so you save money. Now, we can agree that it is in your bank's best interest to keep you in debt for as long as possible. Why would they want to do that? Well, in that way they make the most amount of money from you, and you definitely want the exact opposite. You want to be out of debt as fast as possible, right? And so another way for you to view remortgaging is that it allows you to pay off your mortgage much more quickly. It could literally be the difference between a 35-year mortgage and a 15-year mortgage. So how do you remortgage? Well, there's actually a couple of different ways that you can do it. So you can remortgage in the way that's going to make you mortgage free much sooner, or in a way that's going to save you a substantial amount of money on your monthly payments, but keeping that same mortgage term. And it really does depend on what your goals are. I mean, do you want to A, keep paying the same monthly mortgage payment, but be mortgage free much sooner? Or B, do you prefer to keep the same mortgage term, but make a saving every single month on your mortgage payments, which you can then use to build up your emergency fund, i.e. your savings, or you can use that money to build up your investment portfolio. It really does depend on what you're looking for as a person, but let me go through an example. So let's say you have a 35-year mortgage and £200,000 at 5% interest. So your monthly payment will be around £1,000, and let's say you now remortgage. Let's say the new mortgage is for the same £200,000, but now at a 2.5% interest rate. And let's say you decide to continue paying that £1,000 monthly payment. Now you're paying the same monthly, but by reducing the interest rate from 5% down to 2.5%, you have reduced your mortgage term from 35 years down to 20 years. So now you can pay off your whole mortgage 15 years sooner. So if you buy a house when you're 30 and your mortgage would have been paid off when you're 65, now your mortgage gets paid off when you're 50. And let me tell you, mortgage free at 50 sounds much better than mortgage free at 65. It makes a huge difference. So essentially what's happening here is that because the new interest rate is lower on the new mortgage, that means your monthly payment would be lower. But because you've decided to still stick to that old monthly of £1,000, that means essentially every single month, some of this money is going directly to pay off your principal balance. So every single month, some of the £1,000 goes towards the monthly and some of the £1,000 goes towards the principal. And it is this which allows you to pay off your mortgage much sooner. And you'll find that effect really does compound. So what I mean is, instead of keeping the same monthly payment of £1,000, if you then decide, you know what, I can afford an extra £300 every single month for my mortgage, so now you're paying £1,300 total monthly, then you'll find you can pay off your mortgage off in just 15 years. So that is a further 5 years knocked off. So the example I gave you, you started paying your mortgage off when you're 30, you would have paid it off by the time you're 65. By remortgaging though, you can pay it off by the time you're 50. And now I'm saying if you just put a little bit extra monthly in, you can be mortgage free at 45 years old. We can also compare the total interest paid. So in the example, at 5% interest rate on a £200,000 35-year mortgage, the total amount you pay is £420,000, including interest. That's £220,000 just in interest. But at the 2.5% interest rate, you now pay a total of £300,000. That's only £100,000 of interest. So that equates to a £120,000 saving in the interest by simply remortgaging to a lower interest rate. So this is the first way you can remortgage, and this allows you to become mortgage free much sooner by still making the same monthly payments. So now let's look at it from a different perspective. If you now take a 35-year mortgage at £200,000 at 5% interest, then again your monthly payment will be around £1,000. Let's say you now remortgage, but let's keep the mortgage term the same this time. So now if you remortgage to a new 35-year mortgage for the same £200,000, but now with 2.5% interest, then your mortgage monthly payment is around £700. So by remortgaging, you've made a £300 saving every single month. Over the 35 years, that is a £126,000 saving that would have otherwise gone straight to your bank. But that's not all, because if we now consider that you invest that £300 saving every single month at a return rate of 8% for 35 years, then compound interest means you will have nearly £700,000 after 35 years. That is the power of remortgaging and the power of compound interest. So you can see that both of these examples are very powerful. The first way allows you to slash your mortgage term from 35 years down to 15 to 20 years by keeping the same or a similar monthly payment. The second way allows you to save money every single month, which you can then put aside for an emergency fund, your savings, or you can invest it and have a substantial amount of money after the mortgage ends in 35 years, or a combination of both. Now, the remortgaging option that you pick is going to depend on your financial goals and your investment opportunities. If your goal is to pay off your mortgage as quickly as possible, then you'll want to remortgage and keep paying the same monthly payments, and your mortgage will finish at a much sooner date. However, if you feel like you are just about making your monthly payments currently, then you'll want to remortgage and make lower monthly payments and use the monthly savings to build up your emergency fund, which in the current times, we have seen just how crucial it is to have an emergency fund that can last you 3 to 6 months. Once your emergency fund is built up, you can then use your monthly savings to start investing. Now, when you remortgage, you'll want to make sure you're getting the lowest interest rate possible, so you will need to do some shopping around. Now, something to bear in mind, with the interest rate so low currently, some lenders are charging higher arrangement fees as a way to still make some of their profits. So do make sure you're getting the best deal possible when remortgaging your home by considering not only the interest rates, but also these higher arrangement fees. Overall, remortgaging is a great way to reduce your mortgage term and put savings aside as an emergency fund or to invest. Now, the key is you'll want to make sure you're doing this correctly so that it's in line with your goals and in a way that's going to put the most amount of money in your pocket and not the most amount of money in your bank's pocket. So I hope this video was useful in showing you how you can take off more than half of your mortgage term in a realistic way and save a substantial amount of money. So if you found value out of this video, which honestly I really hope you did, then please hit that thumbs up button. That way you get more of my videos recommended to you, and if you hit subscribe, you won't miss our next video. I hope to see you on the next one. Take care.